There we go. All right, I'd like to introduce Ben. So he is an associate at Holland Hart, and he counsels employers on the design, implementation, and administration of qualified retirement plans, welfare benefit plans, and non-qualified deferred compensation plans. He also advises on executive compensation. So, very qualified, excited to have them. And with that, Ben, I'll let you take it away.
All right, sounds good. Well, thank you everybody for joining us this afternoon, and thanks Tara for having Harris host me. I'm always happy to come out and talk to, again, I like working with audit firms. I used to be an auditor before I became a lawyer, so here I am. And today we're going to talk about 2021 retirement plan legal update. And I'll start by saying that there actually really hasn't been that much that has gone on in 2021, really in the last year or so, with respect to retirement plans as far as regulatory guidance and new legislation. A lot of the guidance that's come out this year, in the last year, dealt with a lot of COVID relief and stimulus bills. Those primarily focused on health and welfare plans. There's a lot that's gone on this year in health and welfare plans. COBRA notice extensions, COBRA subsidy, all sorts of stuff. But retirement plans, it's been relatively slow ever since the CARES Act guidance came out early last year. But I'm going to kind of go back a little bit and spend a little time talking about some of the things that happened at the end of 2019, mainly the Secure Act, which is kind of got overlooked to an extent last year due to COVID, but everything was mostly effective last year. Spent a little bit of time on that, a little bit of time on the guidance that has come out in the last 12 months or so. And then really quick, let's take a spin through what we might see in the future in the Secure Act 2.0. So before I get going, I wouldn't be a good lawyer if I didn't throw a legal disclaimer at you. So what this is saying is that what I'm talking about today, these are my opinions. They're not opinions of the firm. I am not giving you legal advice. I'm not your attorney, unless of course I am. I don't know who's on the call right now. And if you have any specific questions with respect to your plans, reach out to your legal counsel. All right, I already kind of went over this, but this is the list that I'm kind of running down today. Again, a little refresher on Secure Act, and then some of the other Accelerated Appropriations Act, some of the other relief that came out, which is generally COVID focused. Cycle 3 for pre-approved plan restatements, that's coming up. It's really already started at this point. There's been some new DOL fiduciary guidance that has, well, there was issued by the Trump administration right before Trump left office. A lot of that's been overturned. We'll touch on that briefly. EPGARS was updated. That's the Employee Plans Compliance Resolution System with the IRS to fix errors. That was just restated a week and a half or so ago. And then again, we'll talk about Secure Act 2.0, which hasn't been passed yet, but it sounds like it likely will. So the first portion of this presentation really is going to focus on actual changes that need to be made to your plan documents. So in most cases, it's going to be your document providers that are handling these changes, and a lot of them are boilerplate. You don't really necessarily have choices with respect to the provisions, but again, do want to take a spin through of things that you should be aware of will be showing up in your plans at some point in the near future. The first, and again, I'm going to go through these quickly because this is kind of a refresher. This is all, most of this is Secure Act stuff, which was passed in December of 2019, and most of which was effective 1/1/2020. But the required minimum distribution age was increased from 70.5 to 72. And that ended up not being so much of an issue last year because the CARES Act gave plan sponsors the option of waiving making any required minimum distributions. Well, that was only for 2020, so that we're now past that. So now RMDs are back. So going forward this year in 2021, RMDs need to be made. So at this point, though, if somebody hadn't turned 70.5 prior to 1/1/2020, then now the new age is 72. So again, there's just a little bit of delay there by a year and a half. That's not something, again, that plan sponsors, for the most part, I expect aren't particularly involved in it. It's hopefully something that's relatively automated. through your service provider and record keeper. But know that it's happening, and know that eventually there will be an amendment that will come out with respect to these rules. And this amendment for the RMDH, like a lot of these Secure Act amendments, the amendment's actually not required to be adopted until 12/31/2022. So you have a little time until it actually, so it needs to be implemented now. Just doesn't need to be papered until the end of next year, which is why I think a lot of service providers haven't come out with these yet. Another Secure Act change was they closed the stretch IRA loophole, which generally speaking is kind of thought of more with IRAs, and you set it up that way where if somebody died before they reached their required beginning date for their required minimum distribution, then that person's account can be paid out over the lifetime of their beneficiary, unless it was their spouse. So what that did is if your beneficiary was your child, particularly an adult or younger child, then it have a lifetime essentially to take that money out and defer taxation. The IRS closed that loophole with Secure Act, and this also is going to kind of cover some boilerplate language. It's in your 401k basic plan documents, so that'll change in there. What it's done now is that following a participant's death, it generally needs to be distributed to their beneficiary within 10 years of the participant's death. You can't stretch it out over life, except there's some exceptions to that. It can be stretched out over the life of the beneficiary if we are dealing with a spouse, minor child, someone who's chronically ill or not more than 10 years younger than the participant. But for the most part, that loophole has been closed, again, unless you're one of those types of individuals. And again, this is effective now, but doesn't need to be amended until the end of next year. This is actually, I think, probably one of the trickier provisions rather of the Secure Act that I'm concerned that some plan sponsors will get tripped up on. And that's this new long-term part-time employee category that they've created. And what that generally entails is if a participant if you have an employee rather who's worked at least 500 hours a year for 3 consecutive years and they're age 21, then they will be allowed to participate in the plan, at least with respect to deferrals. Deferrals are required under the Secure Act. Plan sponsors would have the option to either match those or not. But what this does essentially is eliminate the 1,000 hours service requirement for these employees. And this is actually going to take a lot of effort for employers that have kind of a heavy part-time workforce, because it's probably going to involve setting up, certainly it's going to involve tracking the hours, but also setting up different payroll codes. For example, if you have this group of long-term part-time employees that only can make deferrals, they don't get a match, there's probably going to be separate payroll codes for the non-match deferrals versus the match deferrals. So there's really kind of, I think, a lot behind the scenes that plan sponsors need to be aware of to make sure that they comply with these rules. And I've mentioned in here that this may be modified further by Secure Act 2.0, and we'll talk about that a little later. But only modify it to make it even easier for long-term part-time employees to get it, not to eliminate the requirement. And the tracking needs to be going on now. So this is first effective January 1, 2024. So that's when long-term part-time employees will be able to make their deferrals. So that means when we're looking back 3 years, starting the beginning of this year, up through the end of 2023, that'll be that first 3-year clock where if somebody has worked 3 consecutive years and hit 500 hours in each of those years, then they will be a long-term part-time employee, even if, again, they haven't hit that 1,000 hours to kind of get into the plan under traditional circumstances. So plan sponsors, again, particularly if you have a large part-time or temporary workforce, it's really important to be paying attention to this and working with your record keeper to track the hours for these participants. Qualified birth or adoption distributions is an optional provision that the Secure Act made available. And at a real high level, it's if somebody has a child or adopts a child, they can take a distribution from the plan, from their account for up to $5,000 per child. I haven't seen any clients implement this yet. I was recently talking with a client service manager from Principal who also said she hadn't seen any of her clients do it yet. So and from what I've read, I just don't think there's been a big pickup on it. I don't know if there's just no appetite or people have been distracted by COVID. But at this point, again, there don't seem to be that many plan sponsors that have implemented it. But to the extent that you'd like to, again, it's a discretionary provision, something that can be added now. And again, that's something that would require an amendment to the plan if you did want to add it. Moving on to the Consolidated Appropriations Act, that was passed in 2020 as well. It was another COVID relief bill, and the only retirement-related piece of legislation there is it provided some limited disaster relief. Actually, I'll take that back. I think there's two. We'll talk about the other one. But it provided some limited disaster relief for non-COVID related reasons. So if you recall, the CARES Act covered disaster relief. We had the COVID related distributions under the CARES Act of $100,000. We had loans up to $100,000, and the deferral of loan repayments for a year under the CARES Act. What the CAA did was take all those same provisions, the distributions, the loans, the extension of loans, and say that if there's another federally declared disaster other than COVID, then you can take a disaster distribution or loan. And this is a pretty limited window and it's already over. It applied to disasters beginning January 1, 2020 through February 25th, 2021. So that window is closed. And if you had a disaster, if you were affected by a disaster in that window, you needed to take the disaster distribution or the increased loan by June 25th, so a month or so ago. So if that doesn't apply to any of you, you don't have to worry about this. If you did offer qualified disaster distributions, then the plan will need to be amended by the end of the next year to, again, just to paper that. But again, they allow plan sponsors to implement this immediately. And yeah, to the extent that you have employees in California, it's probably the main disaster that really, the kind of major disaster that affected the country then was the California wildfires last year, Oregon as well. I took a look at the list of federally declared disasters. The only Idaho federally declared disaster besides COVID in the last year was there was a flood somewhere in northern Idaho. So again, if you're really an Idaho-based employer, particularly if you're in southern Idaho, probably not going to be something that you need to be concerned about. So the next section, so those were things that would actually require changes to your plan document. These next few slides will just cover guidance that affects the operation of your plan, but doesn't necessarily require an amendment. This is something that's worth bringing up just because it was pretty big news when the Secure Act came out, and that is the advent of pooled employer plans, which are essentially, for those that are familiar with multiple employer plans, it's a group of unrelated employers with no commonality that are participating in one plan. And historically, the DOL would not treat a group of unrelated employers as a single plan. It just be essentially a collection of individual plans, all with essentially the same record keeper and trustee. What this pooled employer plan does is establish rules to create what is a multiple open employer plan or an open MEP, where there is one single plan document for everybody that participates in the plan, one single Form 5500 filing, one single audit. And there is, I think, some appetite for smaller employers to join these plans because you get to push a lot of your fiduciary risk off the plan sponsor onto the pool plan provider, also known as a PPP, which is the entity that's responsible for running the PEP. And that PPP must serve as the named fiduciary and plan administrator under 316 of ERISA. And it can be any sort of financial services firm, insurance company, TPA, or similar entities. It's really, it's pretty broad, the types of entities that can sponsor the PEP. I do want to point out, though, to the extent that, it sounds like a great idea, let's offload all of our fiduciary responsibility. Plan sponsors still ultimately you can completely offload your fiduciary responsibilities and duties. So if you ever were to enter a PEP, you're still responsible as a fiduciary for selecting the PEP and monitoring the PPP. So again, there's always some fiduciary responsibility, but a PEP does take quite a bit off the table. I should mention that PEPs aren't subject to the one bad apple rule, which has been kind of a sticking point for some employers in the past, including with PEO plans, multiple employer plans. Whereas if there was one participating employer whose assets were tainted because they weren't following plan rules, then it technically infected the whole plan, it tainted the whole plan. Under this PEP arrangement, if there's somebody who's not following the rules and their assets, again, are essentially become disqualified, rather than tainting the plan, PPP can just push those right out into its own separate plan, and the PEP still preserves its tax qualified status. PEPs first came available the beginning of this year. I know there's some major TPAs and service providers that I'm aware of that have rolled these out. I haven't heard exactly what the appetite has been so far, but again, I think primarily they've been marketed at smaller employers that really want less involvement in their plan. So we'll see what happens if this continue. I suspect it'll probably continue to grow in popularity, especially with the set of types of employers that tend to use PEOs and those types of arrangements. So we will see what happens in the future, but again, I expect this will probably be popular. Another Secure Act requirement that hasn't really hit yet, but will by next summer, is a new requirement that at least every 12 months, a quarterly investment statement, your typical quarterly investment statement you get with your plan balances, has to include a illustration that demonstrates what your account balance would buy you if you use that money to purchase an annuity. There's no, whether or not there's a lot of annuity providers out there that are actually going to be in the market to capture this, I don't know. But the DOL, likes the idea of lifetime income versus, having a lump sum payment that some participants end up squandering. So they have provided, DOL has provided model disclosures and assumptions and regulations. And they require that, again, those model disclosures essentially end up in your account statements, your participants' account statements, at least once every 12 months. And this will first be effective, September 18th, 2021 is when the clock starts ticking. So then there's 12 months from then to include these lifetime income stream disclosures in a quarterly statement. So the latest you could issue that quarterly statement with this first lifetime income disclosure would be June 30th, 2022, but you couldn't wait till 9/30 because that'd be more than 12 months past September 18th, 2021. So again, it's going to be really coming up, starting with your next quarterly statement. It can be included on there or any of your next three. And then once you include it in that initial statement, again, every 12 months, there'll need to be a disclosure. This is something that I expect that your service providers, record keepers will be handling in its entirety. But it's important at least to know that it's out there and make sure that they are following these rules. And it's probably good to know what statement's going to come out in, because again, at least going forward, they'll need to be in there every year thereafter. So there was one other partial plan or one other bit of relief under the Consolidated Appropriations Act. And again, I throw it out here. This probably affects very few plan sponsors, so I won't spend much time on it. But there was some relief during a very limited window for partial plan terminations. And for those that aren't familiar with the partial plan termination, that is when there is a number of layoffs or terminations, involuntary terminations typically, of plan participants. And if more than 20% of plan participants are terminated in a year, the IRS considers it a partial plan termination. Those terminated participants need to be vested. So generally that's measured at the end of the calendar year. What the CAA, Consolidated Appropriations Act relief does is essentially they give you a pass as of the end of 12/31/2020. So if between March 30th, 2020, you laid off more than 20% of your plan participants, at 12/31, you still laid off more than 20%, typically you'd have partial plan termination. But what the relief does is say, well, we're not going to measure it until March 31st, 2021. So if you subsequently rehired a bunch of employees and got back up, so there's less than 20% layoffs by March 31st, then it won't be deemed to be a partial plan termination. Again, we're past that window, but for employers that did have significant layoffs and rehires during that time frame, then this is worth noting. And I'm sure that it's probably something that Harris covered on their last audit update webinar, since it's something I'm sure they'll be looking at the very least next year when they're out doing their plan audits. Another thing that kind of snuck in last year during COVID was changes to the DOL's electronic delivery rules for required notices. So they put out final regulations that generally default or allow employers rather default to all electronic notices where participants can then opt into paper if they choose. There's still kind of a one-time notice that goes out to participants in paper that notifies them of this electronic delivery. But generally speaking, after that, everything goes electronic to the extent that's what employers and service providers want to do. So it's kind of the opposite of the current or the existing framework that generally required paper unless you could opt into electronic, unless of course you had a work email address and your dedicated work computer. But I expect that there'll be a lot of I think a lot of service providers will be going all electronic very soon if they haven't already. And it's worth noting that these new electronic delivery requirements or provisions are not required, they're optional, only apply to retirement plans. They don't apply to health and welfare plans. So to the extent that, again, you have to distribute summary plan descriptions and other health and welfare documents, those will still need to follow the old rules that are more likely to end up in paper for some employees than electronic. That's effective immediately. It went into effect back in last summer. So again, know this is out there, and for your retirement plans, you can probably now move to all electronic notices, at least on the DOL side. The IRS still has different rules for its notices. They have not come out with similar guidance. This one, again, it's probably not something that affects many employers, but throwing it in here because it was recent COVID guidance that happened this year. It actually kind of dates originally back to last year when EBSA, which is the Employee Benefit Security Administration, which is a department of the DOL, put out disaster relief notice 2020-01. And what that disaster relief notice did is it provided various extensions for ERISA notices, relief from distribution errors, loan errors, contribution errors, late remittances even, and future relief in certain circumstances, all in the case if any of those things were affected, if those errors were caused as a result of COVID. And the way it's written, there really needed to be a direct cause by COVID. It couldn't just be a business slowdown. It would really need to be something like, the person, the plan sponsor, the payroll person had COVID or something, or their family member did and they couldn't work and deferrals were remitted delinquently, something like that. That would clearly fit right in this relief. But now that COVID is, well, I don't know if we're on our way out now or not, but we're making some progress, and certainly we don't see the number of people that are sick with COVID as we did before. This relief kind of has less applicability, I think, for most plan sponsors at this point. But know that it's out there, and the relief technically extends from March 1st, 2020, so any issues that started back then, through 60 days after the end of the national emergency. It's otherwise known as the outbreak period. This national emergency, there has been no end yet to the COVID national emergency. This is still ongoing. And really the little bit of update this year is that the DOL recently, or EBSA recently put out disaster relief notice 2020-01, which just essentially says, at least with respect to these provisions, that they are extended this year, and then confirmed they are extended. They'll be extended essentially probably every year until that national emergency is over. Moving along, out of kind of our legislative guidance and other regulatory guidance that's come out, The next kind of big thing on the radar, I think, for a lot of plan sponsors is pre-approved plan restatement. It's that time. We are in now the third cycle of pre-approved plans. So the last one was generally called the PPA restatement, and that was 6 years ago. Now we're in, I think the name is just third cycle restatement, nothing catchier than that. So we're on the third 6-year cycle of pre-approved plans. So anybody on a pre-approved plan document needs to restate their plan onto their new document, their document provider's new pre-approved document between August 1st, 2020 and July 31st, 2022. I don't think anybody was getting these out in 2020, but I know a number of big service providers out there have started rolling out their documents late spring, early summer this year. And I suspect the rest of them will certainly fall in line by this fall. So just keep in mind that needs to happen. You haven't heard from your document provider yet about the third cycle restatement. It's worth reaching out just to get a sense of what their timeline is. The restatements have to be adopted by 7/31/2022. And just for your knowledge, these new opinion letters, the IRS opinion letters, and the tax qualified status of these restatements, these will be effective June 30th, 2020. The old ones were effective back March 31st, 2014. So again, every 6 years when the IRS does this. One thing I just wanted to call out is that these pre-approved plans needed to be submitted to the IRS for approval back in February of 2017. So the plan documents and pre-approved document providers rather asked, and the IRS said no, about the ability to include all this recent guidance that's come out as part of those documents and the actual body of the documents. So things like final hardship regulations rather that came out years ago, Secure Act provisions, CARES Act provisions, the CAA, all this recent legislation and guidance. These will still, unfortunately, there'll be a host of snap-on addendums, most likely on the back of these plan documents, rather than just embodying these provisions in the plan itself. But again, know that they'll be covered, just not in the body of the document. And this is also, I should add, 401k plans only. Extent you have a 403b plan, there is a different cycle. There's, I believe, a couple more years left before the next 403b cycle ends. So I alluded to this in the very beginning, that there's some DOL fiduciary guidance that came out, and just about all of this was issued right at the waning days of the Trump administration, trying to get it in before the new administration took over. This first slide is the only piece of it that's stuck. And I think a big part of that is the DOL had to replace their fiduciary rule that came out back in 2016 with respective investment advice fiduciaries. So anybody that is offering investment advice to a plan, participants could be considered a fiduciary if you meet certain requirements. DOL spent a lot of time. There's a lot of effort that went into this, preparing for it, learning it. It's pretty complicated, this 2016 rule that involved their best interest standard. There's a lot going on. Well, anyways, that was vacated, as you may recall, back in 2018 by Federal Court of Appeals. So all that work was for naught. And what the DOL has come out recently and said is that they are returning to the original 1976, the original ERISA 5-part test to identify whether investment advisor, whether someone providing advice is a fiduciary. And what that 5-part test essentially does, or what it involves really, is entering into an agreement to regularly provide individualized investment advice for a fee. It will serve as a primary basis upon which the investment, count my fingers, serve as a primary basis upon which the advice recipient will make investment decisions. So know that we've, again, officially reverted back to the old rule for determining who's a fiduciary with respect to investment advice. The other thing that came out at the same time, which the Biden administration has said that they will let stand, at least for now, is a new prohibited transaction exemption that allows investment advice fiduciaries to advise participants to roll over their assets from a plan to an IRA that's managed by that same investment advisor. There's somewhat of an inherent conflict there, but this is something that's been done for a long time. and now it's codified in a prohibited transaction exemption, but it's still required to be in the best interest of an advisor. So an investment advisor simply can't just encourage somebody to roll over where they're going to jack up the fees to the extent they're not reasonable. It still needs to be in their best interest of those participants. But this rule will stand. The next is ESG investments, or environmental, social, or governance investments, which those kind of, were the themes, these qualitative themes some mutual funds are using to build their investment, their fund portfolios. And the guidance that was put out in December essentially served to discourage ESG investing. It was pretty clear that you needed to focus as a fiduciary on pecuniary or monetary factors. You can have an ESG fund as long as it performs and the fees are as good and as good as a non-ESG fund, but you couldn't just have an ESG fund just because it's ESG. Again, if those financial factors aren't on par with similar non-ESG investments. The Biden administration recently, May 20th, issued guidance saying that this had been under review for a while, but they formally stated that this rule would not be enforced. So ESGs are now still not discouraged, but there still is kind of a lack of guidance out there on how, whether or not it's prudent for plan sponsors to include these in their investment lineup. So you don't have ESGs and you're interested in potentially adding them, it might be worth waiting. I suspect that there'll probably be some further guidance from the DOL that provides some factors on when plan sponsors might want to include them. So it might be prudent to hold off on adding them. Proxy voting was another thing that was overturned in the same executive order. The DOL is not going to enforce it, but I'm throwing it out there to the extent you heard of it. Retirement plans with company stock or they're invested in collective trusts often had to have get proxy voting requests, and this guidance detailed, what scenarios when plan sponsors were required to vote, when they weren't, when it made sense, or when they needed to as a fiduciary, when if there's small enough interest, maybe they didn't need to vote. There's a bunch of guidance on that. And again, that will not be enforced either. This is an interesting piece of guidance that came up relatively recently this spring, and this is some sub-regulatory guidance on cybersecurity. And this is sub-regulatory, so it's not binding, it's not authoritative. It's interesting in the sense of what they're doing with it. So what the DOL did really is put out a three-part, I think 3 PDF, essentially, series of documents: tips for hiring a service provider, cybersecurity program best practices, online security tips, which read, pretty, again, not legalese, plain English, best practices essentially. But I think what they've done in that is recognized that plan fiduciaries do have a duty to mitigate cybersecurity risk, and to back that up, and this wasn't announced as part of this guidance, but it's come out recently, is that the DOL is beginning to perform cybersecurity audits of retirement plans. So they're not looking at the plan, the financial statements. They're just focused on what plan sponsors are doing with respect to their fiduciary duties regarding cybersecurity. And presumably, again, this guidance they've put out will probably be the minimum standard that they're looking for. We haven't had any clients yet in our firm that have been selected for audit, and I don't have a sense yet, based on kind of the limited anecdotal blog posts and whatnot that are out there, as to whether or not DOL is focusing on large plans, whether or not they're looking at small plans. It might just be the mega plans to begin with. Not really sure, but it's worth, again, talking to your advisors, getting things in order, making sure that as a plan sponsor and fiduciary that you are, have some procedures in place to mitigate cybersecurity risk. The DOL also came out with a little bit of missing participant guidance this year. Again, this is also sub-regulatory guidance, so it's not binding. It's really just a list of best practices and things that plan sponsors could do to find missing participants. And some of the guidance isn't all that practical and actually raises some security concerns and privacy concerns. It suggests things like looking on social media for reaching out to former colleagues to try to find former participants. I talked about publicizing these missing participants, through company newsletters and emails and that sort of thing. And practices like that, I invite fraud, frankly, through advertising. There's a benefit out there and you don't know where the person is. So some of these more public facing things, I don't think there's going to be a lot of pickup by plan sponsors on this. It's just not worth the risk, but there's kind of plenty of other things. And a lot of the guidance is similar to prior guidance they've issued. But again, they're always kind of tweaking their best practices, and the real focus is still on, just making sure plan sponsors are aware that they do have a fiduciary duty to put in some effort into finding their missing participants. They simply can't just send a letter to their last known address, and then when the participant doesn't respond, say, oh, that's good, we're going to cheat the benefit to the state. It just doesn't work like that. There does need to be some good faith efforts and multiple tries, multiple manners to try to locate these missing participants. Next, we'll talk about EPCRs. This just came out, the new revenue procedure 2021-30, maybe a week and a half ago, maybe 2 weeks ago. And for those of you not familiar with EPCRs, it's the Employee Plans Compliance Resolution System. It's the IRS's correction procedures, allow you to self-correct, or VCP, voluntary correction program, make corrections for operational failures, plan document failures, really most types of kind of day-to-day plan failures that you run into. This has always been contained in a revenue procedure they issued. This latest revenue procedure supersedes the previous one, which was 2019-19. Kind of liked how easy that one was to remember, but I'm sure I'll be able to commit 2021-30 to memory eventually. But what the significant changes, everything for the most part remained the same, but there were a number of big changes to EPCRs. The first, they expanded the ability to make retroactive plan amendments under self-correction. Even before 2019-19, you could even self-correct with a retroactive amendment. You needed to go into a VCP, which required an application with the IRS. The previous version of EPCRs added self-correction through retroactive amendment. This is built on that. It makes it even a little easier to do. Before it needed to affect, need to be an amendment retroactively that affects everybody. Now it can affect just targeted groups, some other requirements as well. The new EPCRs expands the self-correction period from essentially 2 years to 3 years, a little more than that, but generally 2 to 3 years. If you have a significant failure, it can generally be, previously it could be corrected, needed to be corrected within 2 years. And if it wasn't, you need to do a VCP filing with the IRS. Now you have 3 years to correct those significant failures. There was also an extension of some safe harbor corrections for automatic enrollment failures. Under the previous rules, there was a safe harbor. If you failed to enroll people under automatic enrollment, you had 9.5 months from when they should have been enrolled to get them enrolled, and there would be no missed contributions that plan sponsors needed to make up. That relief was in EPCRs that was set to expire, or did expire technically 12/31/20. This new one serves to extend that out through the end of 2023. And we'll talk about it later, but the Secure Act 2.0 seeks to make that permanent. There's an increased de minimis amount for corrections of overpayments from 100 to 250. So if you overpay somebody out of the plan, you don't have to ask for it back. For that was 100, now up to $250. You don't necessarily need to request it back from the participant. Keep in mind though, there is no de minimis amount for amounts that are owed to plan participants. So even if it's a dime, technically the DOL and the IRS would consider that, would require that correction to be made, as those of you who have probably dealt with lost earnings with DOL have seen. But again, to the extent there are overpayments, there is a de minimis. There's some new guidance on pension plan overpayments. I should have mentioned at the beginning, obviously, we're not really covering defined benefit pension plans here, but there's some relaxed fiduciary requirements there on overpayments and what you can do. And also, they used to be able to file an anonymous VCP filing with the IRS if you were kind of proposing a correction that you weren't sure if they'd accept. They have eliminated that and instead put in pre-submission anonymous VCP conferences. So you can request a conference with the IRS to talk about the issue, what you're proposing to do. Once it's actually time to file that, it can't be anonymous. All right, so this last section of the presentation is kind of going to be, I'll make it relatively quick because I'm going to talk about Secure Act 2.0, which is technically Securing a Strong Retirement Act of 2021. This is still pending legislation. It's in the House. It's House Bill 2954, but it's been called throughout the industry Secure Act 2.0. And the reason I bring this up, besides the fact we need to fill some time based on the lack of 2021 guidance that came out, is that from everything that's been written, sounds like there's very strong bipartisan support with respect to this bill, which is pretty rare these days. So the fact that you know, both parties are for the most part in on this bill suggests strongly that it will pass at some point, either this year or maybe next year. From what I understand, it probably needs to be attached to some sort of spending or budget bill to get it passed, but it should be one of those again towards the end of the year. So it's entirely likely that some version of the Secure Act 2.0 will pass this year and potentially go into effect beginning of next year. But where it stands now is it was reintroduced a while ago, it was pulled back due to COVID, and it was reintroduced on May 5th by the House Ways and Means Committee. They approved it unanimously. So now it's awaiting a full vote of the House. Once they have that, the Senate will work on their version, and then once they conference together, they'll kind of hammer out the details. But what it does presently in its current form anyways is cover 6 broad categories. They're expanding coverage and increasing savings, trying to preserve retirement income for participants, clarifying some rules, make some technical amendments on things that just need to be cleaned up. There's some administrative provisions. There's also some revenue raisers in there as well to increase tax revenue. And these, as you'll see in my next bunch of slides, there's varying effective dates. Some are effective immediately, some would be effective, assuming it passes this year, next year, some are effective a couple years down the road. So it varies as it currently stands. And I do want to flag that this is a pretty large retirement plan bill. It's bigger than Secure Act 1.0. And I've only kind of flagged provisions which I think are particularly interesting. There's quite a few more provisions that either didn't necessarily touch 401k or 403b plans or just weren't, frankly, sexy enough to put in this presentation. So the first is required automatic enrollment. What they're looking at is that any new 401k or 403b plan that's established going forward would be required to have automatic enrollment and automatic contribution increases, which again, that's kind of big news, is they're taking that out of the hands of plan sponsors. And you know, those rates would have to, plan sponsors would be able to set the rate of the automatic enrollment between 3% and 10%, and they could cap automatic increases between 10% and 15%. But it's you know, it's kind of a big step there. It takes some of this control away from new plan sponsors. Now, existing plans would be grandfathered, so to the extent a plan didn't have automatic enrollment feature, then it wouldn't need to put one in. But again, any new plans would need to have one. There's an increased credit for small employer plan startup costs. Now, I suspect probably a lot of you on this webinar are retirement plan audit clients of Harris. You probably probably have over 100 participants, so this wouldn't apply to you, but this generally applies to employers with under 50 employees. And there is a phase out between 50 and 100, where it increases the amount of startup cost credits employers could take. Secure Act put in some startup cost credits. This expands it, so you can take even more now, up to 5 years, up to $1,000 per employee per year, just to cover startup costs, to the extent that once all your startup costs are covered, you wouldn't get additional credit beyond that. But again, there's for smaller plans, essentially probably if you have enough participants, you won't get 100% of your startup costs covered. 403b plans in the ability to invest in collective trusts, that would be a departure from the current rules, which only allow 403b plans to invest in annuity products and mutual funds. So what this would do really is put 403b plans on par with 401k plans, which have been able to invest in collective trusts for years, which is a good thing because a lot of times those collective trusts arrangements, particularly with respect to stable value funds. Those investment fees tend to be less than mutual funds. So that'll be a good change for our not-for-profit sponsors out there. We talked about SCARE Act 1.0 increasing the required minimum distribution age to age 72. Well, SCARE Act 2.0 wants to increase that even more. They're talking about age 73 at the end of, or beginning rather, next year, age 74 in 2029, age 75 in 2032. So that's good news for participants. They're going to be able to continue to grow their retirement accounts without having to take money out and be taxed on it. So it'll be interesting to see where that goes, but it seems like there's been an appetite. Just the fact they raised it in SCARE Act 1, that wouldn't surprise me if this ends up in the bill going forward. There is an increase in catch-up contribution limits being proposed. I think, as everyone knows, right now, if you're over age 50, you can put an additional moment $6,500 in above the maximum deferral limit for the year. And what they're proposing now is that in your final 3 years before retirement age, or age 65, plan participants will be able to put in up to $10,000 for each of those years. And this will be indexed for inflation as well. So presumably that would grow as the regular catch-up contribution limit grows. So it gives you that last chance before you reach age 65 to get some additional contributions into the plan. And these kind of seem in jumbled order. You know, thinking back, I probably should have rearranged them, but this is the order they are in the bill. So however they decide that, this is kind of the order of the things we're following here. So another 403B plan one. 403B plans will be able to participate in multiple employer plans or pooled employer plans we've talked about before, PEPs. It's not something they can do currently. So again, it's just kind of, again, bringing them along and having those 403B rules kind of sync up more closely with 401k plan rules. This is a big one. There's some ways to do it now, though it's somewhat complicated and not that there hasn't been a big pickup on it based on some DOL or IRS rather private letter ruling. But now they want to codify the ability for plan sponsors to match student loan repayments. So what it would mean is that if you have a qualified student loan repayment, which generally means it's going to cover most loans, both federal and private, for college, then those student loan repayments would be treated as deferrals for matching purposes. So the goal is to, what you've obviously probably read a lot in recent years is that the younger generation isn't able to have such high student loan burdens that they're have a hard time saving for retirement. So what this will do is allow them to pay their loans as they normally would, but they're going to get matching contributions for it. So this is a great benefit. It'd be optional. It'd be a great benefit for those employers that are interested in doing that. And that would, those loan payments even count towards safe harbor deferrals. So if you need to defer a certain amount to get your full safe harbor match, it would count towards that. So this is a big change and something that I think a lot of plan sponsors will adopt if this becomes law. There's yet another small employer plan credit, this time for employers up to 100 employees that get some startup costs for joining a MEP or a PEP. So again, if you're joining a multiple employer plan, you can get some additional credits for that outside of that other startup credit provision that's in there. This is something that I don't know if there'll be much traction on it, but it's an interesting thing. Is that right now there's something called the contingent benefit rule that prohibits any sort of incentives, prohibits rather plan sponsors from providing any incentives outside of the plan to participants for their deferrals into the plan. So right now employees can receive match. That's the only thing they can get from an employer to encourage them to make deferrals into the plan. An employer couldn't give them a bonus, couldn't give them a gift card or something outside the plan under the current rules. What they're proposing doing here is changing this so employees can receive a de minimis cash incentive outside of the plan if they elect to contribute. So again, to the extent you have a low participation and you really want to get employers in the plan, and maybe that involves giving them I don't know, they haven't defined what de minimis is, but maybe a $100 cash bonus for their deferrals after, if they defer for a certain amount of time, or a $50 gift card or something like that. But it's just another way to encourage participation. We talked about a little bit about this in the extension of EPCRs. They are considering adding a safe harbor, or making that safe harbor permanent for auto enrollment failures, which would mean that if you missed adding someone for auto enrollment in the first 9.5 months after they should have been auto enrolled, you don't need to restore any missed contributions. So they're looking at making that permanent. I alluded to this one before too. The long-term part-time employee rules, which everyone should be measuring right now. STRAIR Act 2.0 wants to bump that up from 500 hours for 3 consecutive years to 500 hours for 2 years. So it wouldn't change the measurement day. It would still be measuring as of January 1st of this year. But if this passes, then might need to implement or allow these long-term part-time employees to make their deferrals as early as January 1, 2023 instead of 2024. There's some additional relief for overpayments, more on the DB side, but what you can do from a fiduciary standpoint as far as getting the money back. I won't go into that here for the scope of this presentation, but know that it's out there and being considered if you have DB plans. They are considering reducing the excise tax for failure to take a required minimum distribution. Right now, that excise tax is 50%. They're going to knock that down to 25% if you don't take one timely. There's some other ways to get around that. You can do a VCP filing for your plan sponsor. You can request relief if it wasn't your fault. There's a form for that as a plan participant. But if you were actually tagged with the excise tax, that's going to be lowered to 25%, and it'll be as low as 10% if there's correction within the first 2 years. There would be relief for eligible employees who aren't actually enrolled in the plan from receiving plan notices. Right now, anybody who's eligible but not participating still is required to get a slew of annual notices, safe harbor notices, summary annual reports, qualified default investment, alternative notices, all these DOL notices that are out there, and IRS notices for that matter. They would not need to be provided to employees that don't enroll. So again, I don't know how many plan sponsors are handling this versus their service providers, but to the extent that you are, it'll save you a little time and effort from an administrative perspective. PBGC is going to create a lost and found for retirement benefits. It'll be a searchable database, and it would include defined contribution plan benefits. So that is, I think that's already in the works as is, but now it'll be potentially codified in the law. There's going to be some more expansion of the self-correction procedures under EPCRs to make it so you can self-correct eligible inadvertent failures, and which they haven't clearly defined what those are in the current draft of the bill. But I think what's potentially even, well, maybe not bigger because it depends how they define it, but what's also big here is that you'll be able to self-correct loan failures. Right now, under the current corrections program, if there's some sort of loan failure because you defaulted on a loan, that those would need to be corrected through voluntary correction program. So they're saying now you'd be able to self-correct, which is a big for employers. Hardship self-certification, again, it's done frequently now, but again, it'd be codified in law that participants can self-certify the hardship events, and they can self-certify hardship amounts. There would be an option for plan sponsors to add domestic abuse distributions. So if somebody was a victim of domestic abuse, they could take a withdrawal of up to $10,000 from the plan and not pay an early withdrawal penalty. And that amount could later be recontributed to the plan if so desired. In these last couple of slides, actually, I think are particularly interesting. These are revenue raisers. What they're proposing doing is that treating all catch-up contributions as Roth contributions. So Roth are after tax. So what it would do is you make your pre-tax contributions up to the 402G limit. Anything beyond that catch-up, you'd be taxed on. The good news is that those Roth contributions will grow, the earnings will grow on a tax-free basis. So that's the silver lining, but you would pay those taxes up front on all catch-up contributions. And lastly, kind of similar, is that they are considering giving plan sponsors the ability to actually let participants choose whether or not they want to treat their matching contributions as Roth. So if you elected to do that as a participant, you would pay tax. It'd be taken out of your paycheck, and that contribution, that paycheck where the match goes in, and those matching contributions would be treated as Roth contributions, and again, earnings would grow on a tax-free basis. So that's these last two are pretty interesting. To drive revenue now, but also though, to the extent employees do this for a long time, they're going to have some significant potentially tax-free earnings to draw on and contributions when they eventually take their money out. That is all I have, and I know I've covered a lot, so I really appreciate everybody hanging in here. So let's see if we have any questions. If anyone has anything now, you can throw it in the chat window. Otherwise, Tara, did you see any questions come in?
They come in to me. Yeah, we'll just give a couple seconds here. As you're thinking of questions, if you have any, I just wanted to thank you again, Ben, for your time. That was an awesome presentation. We've got the whole thing recorded if anybody needs to dive back into any of that information. And if you think of any questions afterward, he's got his contact info here, and we'll share that with you again in an email. So thanks again. Nothing on my end. So I'll just kind of, to wrap up, we will have a follow-up for those of you that needed CPE. Thank you for answering those polling questions. We do have a survey that needs to be answered, so that'll come out in an email before we can send your certificate. And then we will have invites coming out soon for part 3 of our webinar series, and that is going to be August 18th at 11 a.m. That'll conclude our summer series, but we have Shane Hansen with Empower Retirement as our guest speaker for that. He'll be doing an investment update, so kind of our third part of what all of our EBP clients need to know. So more details on that coming soon. And I think that is all we have. So.
And let me just jump in real quick and just say, I know we're out of time, but if anyone has any questions that come to mind or want to chat, feel free to reach out. My contact information is there, and it'll be in the slides that are on the recording. So yeah, thank you for having me, Tara. Thanks for joining us, everybody.
Thanks so much. Have a great rest of your week.